The market ended yesterday fairly mixed, although it wasn't a great day for the semiconductor industry as a whole. Today we want to focus on the hardware aspect, Dell Technologies, which as we can see in the pre-market, they are down more than 12%. In fact, they have started to recover a bit. They were down as much as 15%. Now we want to understand, why is this company coming down quite a significant amount, given the fact we have a triple buy rating and a strong buy from Quant. So is this one we should consider in our portfolios, and are there any external factors for the industries that we do need to understand? Now first thing, let's jump into their earnings report, and we can see the main reason for the fall today is that they had a light forecast despite their growing AI sales. Now before we look at the numbers, this is one thing that we need to understand as we move on. A lot of companies in the S&P right now are priced to perfection, so it isn't just enough to beat the earnings. As we can see here, they've beaten their expectations for the EPS. You have to at a bare minimum guide what you were anticipating before. Any weakness, as we can see, will be punished, and rightly so, by the market. Now it does talk about how the shares are already up very significantly, as we will come to show you, and investors do believe this is one of the most important companies selling both tools and systems for AI developers. So let's take a look at the numbers, the reason why this company has fallen significantly. Now look, earnings per share looking fairly strong, 215 above the 206 the market wanted to see. Their revenue, although it was a miss, it was very light, but as we said, weakness will be punished. 24.4 versus 24.67. Bottom line looking good though, up 12% to 1.12 billion, and we also notice revenue in comparison to the same quarter last year is up 10%. Now for the revenue for the next quarter, that is Q4, Dell anticipate 24 to 25 billion, and look, analysts were expecting 25.57, and that is ultimately the major reason for why we got that very large drop. We do also notice that that has affected the earnings per share, where they anticipate 250 as opposed to the 265 the market wanted. Now a quick summary, the EPS was a nice beat, revenue did come in marginally lower, but they are guiding for the next quarter, unfortunately, less than what the market wanted on both EPS as well as the top line. The other thing that is interesting to note, the Chief Operating Officer, he did mention that growth from AI will change from quarter to quarter. So what we would say based on this information, we wouldn't be surprised if this industry in particular does see a lot of fluctuation, but also extending to those that are heavily impacted by artificial intelligence, like semiconductors, like Nvidia, and as we just saw, yesterday wasn't the greatest day. So more fluctuations, more volatility is anticipated, and they also believe here that the business will not be linear, especially as customers navigate an underlying silicon roadmap that is changing. So let's just go back to the actual metrics of this company, and first thing to spot is when the market does open, they will be trading around the midpoint of the 50-week range. The yield will be higher, right now around 1.26, moving towards 1.5, maybe even towards the 2 percentage point. And we can see the forward PE right now just above 18 will come down lower, which is anyway still significantly lower than the S&P right now around 25. Over the last year, it is up 90%, so it has massively outperformed the S&P, and over the last 5 years, the same to be said, up 166%. In terms of their earnings moving forwards, well, they are anticipating double-digit growth every single quarter, so they do believe they will still continue to ride the artificial intelligence wave. When we look back at the last 4 quarters, they did miss one, so that is a 75% track record, 3 out of 4 beats. Good to see, as always, the most recent quarter, just yesterday, was a healthy beat, and ultimately, over the next full year, they do expect earnings per share to increase, thereby lowering the forward PE to 15. Now before we dive into some of their financial metrics, we just want to highlight a few key slides from their investor presentation just yesterday. The first one is a bit of an overview. As we saw, their top line did come in very strongly, up 10% on a year-on-year comparison, and we can also see that their earnings per share, whether you look from a diluted basis or from a non-GAAP diluted basis, we are still talking about double-digit growth. They talk about how their order demands continue to increase. Right now, it is sitting at a record 3.6 billion. That is up 11% in comparison to the previous quarter. They talk about a significant amount of AI backlog, 4.5 billion in fact coming out of this more recent quarter, and also how the artificial intelligence pipeline is growing more than 50% sequentially with growth right across all customer types. Nice to see that isn't isolated to just one element. We also love the strong cash flows that are generated by this company, and that will be used within our stock valuation process towards the end. And they've also done some very nice increases to the dividend we'll touch upon, but on top of that, returning excess cash through share repurchases, something we do believe they will continue at least into the shorter term. If you want to see the numbers, well, revenue up 10% on a year-on-year comparison, operating income 12%, earnings per share up 16%. So right now, this company does look like the growth is very strong. Whilst they do believe there will be some bumps along the road, it does look like they will benefit massively from this growth that we have been told many times, the artificial intelligence boom that is not only coming, but that we are seeing right now on a day-to-day basis. In terms of the guidance, well, next quarter they expect around 10% growth. As we can see, they anticipate to continue to do some share repurchases. We will talk about this from a historical point of view, and their earnings per share to be around $2.50, which would be up around 14% at the midpoint. Now, they also look towards the financial year of 2026, and they talk about multiple tailwinds that they believe will support their growth for the next year, more robust AI demand, and they say they have a strong 5-quarter pipeline going into next year. That is very, very good to see. And ultimately, they expect to continue to balance growth as well as profitability, managing price within the competitive landscape and input cost environment. So they are singing all the right tunes that investors do want to see. They also have the numbers to support that just over the more recent quarters. And what we also like about this company, they have gone into quite a bit of detail in their investor presentation. So if you are interested, do go check that out. It is directly on their website. But they talk here about how they expect their revenue moving forwards to grow at around 3 to 4% on a compounded annual growth rate. That is pretty much in line with inflation. Remember, we talk about hitting that 3 to 4 just to keep up, due to the fact that in the US, the inflation rate over the last 40 years has been at 4%. So for your own personal reference, if you're not increasing your dividends, your salary, or your other income producing assets at that 4% rate, then you are in fact taking a pay cut, losing your purchasing power. What is nice to see though, their earnings per share is growing at a much rapid rate at 12%, again on a compounded annual growth rate. I also like the fact that they have split out how they are committed to the long-term value creation, but more importantly, they do believe dividend growth is important to their shareholders, and therefore they say they target to grow the dividend at 10% or more all the way through to the financial year of 2028. And just in the more recent increase, again, we will cover that was at 20%. So I'm sure dividend growth investors will love to see that. But now let's take a look at the metrics. What do they tell us? First thing, dividend safety score at 70, indicating safe. We'll cover these two valuation models, but we also notice, as they've just mentioned, they increased the dividend 20% in March this year. Now, for those that want to know, it was reaffirmed just a few months ago, the safe score, which ultimately means a dividend cut is unlikely, and we're not surprised about that. They're talking about increasing the dividend around 10% over the next few years. Now, key metrics from the recession of 07-09, no dividend was paid, so no comparative data, and they also have negative 19% recession sales. That was below the average of the S&P, which was around negative 12. Very nice to see their dividend growth. We do expect this to continue at a very strong rate. They'd also point out here that they've only been increasing those dividends on a consecutive basis for 1 year. Now, this valuation is purely based on the forward PE, and also important to understand, we don't look at these models in isolation. We will get to our own valuation process shortly. Now, the blue tunnel talks about the expected fair price. Right now, though, we can know over the last year, this company, based on this model, has been trading severely overvalued. And even with the drop, we can take a very quick look, anticipated to be around $124. That will still bring it above that expected fair price. So based on this model, we do get a sense of overvaluation. Now, in terms of dividend yield theory, talking about a company essentially is undervalued when the current yield sits above the 5-year average. Right now, overvaluation. Again, the same to be said on the forward PE. 16 is above the 5-year of 9.8. When we do take a look at the comparison, the sector at 26.4, Dell right now at 16 is trading at a discount. Does it deserve to trade at a discount? Well, we will compare it against the sector median for a few number of metrics. Now, first one we're looking at today is the free cash flow payout. Remember, free cash flow over the earnings, it is susceptible to manipulation by management through accounting. Below 60% is what we want. Reason for this, gives us faith management can offer those very juicy double-digit increases that they have ultimately promised to shareholders at a minimum over the next few years. 18% in 2024, 17% over the next 12 months, so that is a good sign. We would be surprised if they don't hold up what they have said in that investor presentation. And free cash flow, ideally we want to see consistent increases over the long term. Yes, it has increased from 2015 to 2024, but we do note significant inconsistency, and we can point out over the next 12 months it is expected to increase to around $10.50 per share. Then we get to sales growth, where we want to see around 3 to 7%. Remember, 3 to 4, like we mentioned, just to keep up in line with inflation. That is what they have had over the last few years. However, we do notice 4 of the last 10 years, including 2024, have been negative, minus 14%. On a trailing 12 month at 3%, pretty much indicating for the next full year, they are expecting to come in line with inflation. And when we zoom out over the last 10 years, we can see that growth, albeit a little bit inconsistent. Now, shares outstanding, we did touch upon this. Ideally, we want companies returning excess cash to investor pockets through those share buybacks. Now, they would have diluted your position if you did buy in 2015, as we can see, nearly double. But what we do notice from 2022, they have started to do share buybacks, something hopefully we do expect them to continue at least for the shorter term. We then move on to the ROIC, 10% or more. Give us faith, management are able to effectively allocate their capital. Now, very inconsistent. The positive to take is from negative 3% in 2018. It has started to increase, moving in the right direction. We get 3 years of consistency, as well as on a trailing 12 month at 27%. So maybe you could look at this and gain some comfort that it does look okay, or maybe you do want to consider adding an element of a margin of safety, like we will run through in the valuation. Operating margin, not just above 12% is what we want to see, and we don't get. We also want to note operating efficiency, margins increasing. Again, we get that from around 2018, where it has gone from negative 3 to 7%, but ideally we do want to see this at a higher level. We will, as a side note, compare this against the sector median shortly too. Free cash flow margin, around 5%. It does straddle around that year on year, nothing too fancy to note. And then we get to the net debt to EBITDA, referring to the earnings before interest, tax, depreciation, amortization. Below 3 is what we want. Number of years below highlight the number of years it would take the company to pay off all of their debt net of cash on hand. Now, we do notice 1.15 in 2024 is good to see. Remember, this does correlate to balance sheet strength, dividend safety, expected to go a little bit lower over the next 12 months. So these are good signs. We do like this from Dell, and hopefully it is something they will continue moving forwards to pay down and delever the balance sheet. Now, we also want to let you know we have released our latest free weekly article where we run through 2 beaten down stocks with over 30% upside, and we deliver one of these to your inbox every Monday morning, where we cover severely undervalued stocks for your attention, as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away. You'll also be able to gain access to 40 undervalued dividend stocks for the month of November. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently sent out copy of 29 undervalued dividend stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and start reading straight away. We then move on to insider ownership that sits at 47%. That is very high. In terms of the selling, we note around 4 billion. That is just over the last year. In the more recent quarter, around 1.34 billion. Now, we'll show you for transparency who these insiders are, but in all honesty, it isn't something we use in our own investment thesis, given the fact it isn't a bearish signal. Management sell for many reasons, personal and financial. We have just a few days ago, the CFO, Chief Financial Officer, sell around 8,000 shares, netting them around $1.1 million. Again, information is there if you want to use it. Institutional ownership, well, 38%, around 4 billion worth of sales over the last year. During the same time frame, we do see more buying, and we also notice in the more recent quarter a lot more buying, 2.43 billion over 542 million worth of sales. But as always, never copy what the institutions do. They have been bullish on this just in the more recent quarter, but always do your own due diligence. Then we want to take a look at the income statement. Yes, we've already highlighted their top line revenue growth. As we can see, over the longer term has increased, although a little bit inconsistently. We do want to highlight the bottom line net income. What story does that tell us? And we can see, similar to their top line revenue, a lot of inconsistency. In fact, for quite a significant number of years, we're talking 5 of the last 10, they reported a net loss, and it has turned into a net profit from January 2020. Again, inconsistency shining through, something we would say to factor in to your margin of safety. Now, a quick health check, total cash versus total debt. As we can see, inconsistency throughout the balance, around 5.4 billion in 2015, around 4.7 in the latest quarter. But as always, one number in this balance sheet won't tell you anything, which is why we compare it to their total debt numerically and directionally. And what we can in fact see, it has increased, although again, inconsistently and coming down from the highs of 2017 to 2020 at 14 billion to around 25 in the latest quarter. As we can see, it did hit a high of around 54 billion. The net debt to EBITDA, as we saw, did look okay, but definitely something just to keep an eye on, as it did go fairly high not too long ago. We then want to have a quick look at the cash flow in terms of the cash from operations that this company does produce, and we get it. Look, we can see there is a lot of inconsistency throughout. Nonetheless, it has increased from 2015's 2.5 billion to just under 9 in February 2024, which is the year end of their annual accounts. Now let's get into some gradings. They get a D+, a little bit confusing because when we take a look, they are trading at a discount to the sector. 18 on the P non-GAAP forward basis, 25 for the sector median. So if you're buying this company right now, you're getting a near enough 29% discount. Bear in mind, company has fallen in the pre-market, so we expect the discount to be even higher. And we can see whichever valuation metric you do use today, this company trading well below the sector median. We then move on to the growth grade where they get a C+. Now negative 2% with the sector at 4.25, 1.14 forward looking with the sector at 5.37, and then we move to the earnings per share over the next 3 to 5 years at 12%. As we can see, sector median higher at 15.3. So look, you could argue, yes, based on growth, it does deserve to trade at a discount. How much? And is there a margin of safety that we can apply making it a buy today? We will cover that as well. Profitability, A+. Now gross margin, very poor, 23%. Sector significantly higher at 51%. Their bottom line, however, is looking marginally better, 4.32 versus 3.61. And we also notice their cash from operations over the last 12 months, very high, 6 billion versus the sector's 96 million. Now a quick recap, we have a double buy from Seeking Alpha, a strong buy from Quant, D+ on valuation, C+ on growth with an A+ on profitability. Now 2 parts before we do jump into the valuation. First one, comparatives against some in the similar sector and size. When we look at the total return, including dividends reinvested, we notice this company is, or we should say was, the best performing at 93%. It will go lower after the market open. Over the last 5 years, we also see the best performing up 464%. Now, yes, these are very strong numbers, but do bear in mind that past performance is not an indicator of the future. They could ultimately perform significantly better, but they could perform significantly worse. In terms of comparison, absolutely blown the S&P apart over the last year. We do expect this still will hold true after the drop today. And over the last 5 years, again, the same is to be said. As always, though, do remember when looking at individual stocks, you do need to have that confidence that they will outperform. Otherwise, you may as well consider a low-cost ETF that does track the S&P like VO. Now, in terms of our intrinsic value today, it is the average of these 4 models. And as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are notified as these videos drop. So let's quickly run through these models. The first one we have, Graham's valuation, the EPS, long-term growth rate, AAA corporate bond yield, to give us our first intrinsic value showing undervaluation. Remember, we're not looking at any of these models in isolation. We then get to the multiples companies in a similar sector and size, average P multiplied by the EPS of Dell, and we can see our first overvaluation signal. We then move on to the dividend discount. Now, they did say they're targeting 10% growth moving forwards, 16 over the last 2 years, but we want to be very conservative, 6.75 indicating undervaluation. We then move on to the DCF model, free cash flow year on year. Growth has been very high over the last 10. We want to be again conservative at the 6% rate. With a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, another undervaluation, so 3 to 1. So as we said, the intrinsic value is just the average of these 4 models, and you can grab a copy of this by clicking on the pinned comment below, running through your own numbers, whether it's for Dell or any others that you do desire. Then we use a margin of safety on every stock that we do analyze. 10% execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Look, if you believe that today, a buy up to around $129 at 15%, it is pretty much trading around that level. So for Dell Technologies today, we see 15% MOS, Wall Street indicating a price target of $160 over the next 12 months. That is upside of 30%. So give us your thoughts below. 15% MOS, 30% upside from Wall Street. Is this one to buy, maybe hold, or in fact consider selling? We'll also show you here if it does go down further in the market today. 20% a buy at 115, 25% around 108, and with 30% we are looking at the $100 mark, somewhere it wasn't long ago sitting at, where we did believe it was a good consideration for the portfolio. As we said though, today's episode 15%, 30% upside. Give us your thoughts. If you've enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.